Welcome to The Explainer, where we take these super complex documents and, well, we make them make sense. It's a question that hits all of us, right? But the answer, it always feels like it's locked away in some dense, totally inaccessible language.
Well, today we're doing something a little different. We're looking at the actual source code of the tax system, the official rule book for a nation's income tax, to really understand how it's all put together.
So here's our game plan. We're going to follow the logical journey your income takes as it moves through the system. We'll start with how it's defined, then look at how you can save, and finally, see what happens if you break the rules. Okay, let's dive in.
First things first, what exactly is this document? You can think of it as the ultimate blueprint. It's the single source of truth that governs how income tax works for literally everyone, laying out every single step, definition, and consequence.
The entire system really gets built on one foundational question. Before you can tax income, what does this rulebook even define as income?
A perfect example is Clause 16, which defines salary. And you can immediately see how specific and technical the language gets. It's not just your base pay, it's also talking about things called perquisites and special allowances.
But all that legal complexity really boils down to a pretty simple idea. At its core, the bill is saying that almost any financial benefit you get from your employer is considered part of your taxable salary. And this really shows you just how comprehensive these rules are. It's not just about a paycheck. The bill has entire chapters dedicated to defining income from things like house rentals, capital gains, and business profits. The takeaway is clear. Every possible source of income is accounted for.
So once the bill defines all your income, it does something else pretty important. It provides you with clear, legal pathways to reduce the amount that actually gets taxed.
For example, let's circle back to that income from a house property. Clause 22 gives taxpayers specific deductions. You can deduct the interest you paid on a loan you took to buy the property, but it also gives you a standard deduction.
And that standard deduction is a clean 30% right off the annual value. This is a great example of the rulebook creating a simple, fixed rule to help avoid super complex calculations for every single taxpayer.
The bill is also just full of these hard-coded numbers. Schedule 2, for instance, sets a specific monetary limit. If you get a payout from a voluntary retirement scheme, the first 5 lakh rupees of that money are completely exempt from tax.
So, you've calculated your income and you've applied your deductions. After you file your return based on all these rules, it enters the official review stage. And this is known as the assessment process.
Now, the crucial thing here is that this isn't some black box. There's a clearly defined step-by-step procedure. It starts with you assessing yourself, but it can move to an inquiry or even something called a best judgment assessment if you don't comply. And what's really interesting is that it all culminates in a modern, automated, and anonymous digital system called faceless assessment, all laid out right there in the rules.
But what happens if you go through that assessment and you just flat out disagree with the outcome? Well, the rulebook anticipates this. It has a whole system built in just for disputes. It's a clear, hierarchical path. You can think of it like a ladder of appeals. You start with the Commissioner of Appeals, you can move up to the Appellate Tribunal, and for very specific legal issues, you can even take your case to the High Court and ultimately the Supreme Court. It ensures every taxpayer has a structured way to be heard.
Of course, no rulebook would be complete without spelling out what happens when you don't follow the rules. So the final part of our journey looks at the consequences.
And right here, the bill makes a really critical distinction. There's a big difference between simply underreporting income, which might be an honest mistake, and deliberately misreporting it by hiding facts or creating false entries. And the penalty for misreporting is 4 times higher, jumping from 50% all the way to 200% of the tax you owe.
The consequences laid out in Chapter 22 are serious. They can range from these steep financial penalties all the way to, in cases of willful tax evasion, even rigorous imprisonment. The rules are clear. The system has teeth.
So when you take a step back, what we've seen is that the income tax bill isn't just a random collection of rules. It's a single, logical system that maps out the entire life cycle of your tax journey, from the first dollar you earn to the final check on your return. Peeking behind the curtain and seeing the actual architecture of the tax code is just incredibly empowering. It demystifies the process and reveals the clear, step-by-step logic behind the rules that shape our financial lives.
Thanks for joining us on The Explainer.